Most U.S. exporters leave government-backed financing on the table. EXIM Bank and the DFC were created specifically to help American businesses compete and win in global markets. Most companies never use them, not because they do not qualify, not because the programs are too complex, but because nobody ever clearly explained what these agencies actually do, who they are built for, and how to access them. If you are a U.S. exporter or investor with international exposure, this video is for you. 2 agencies, 1 mission. EXIM Bank, the Export-Import Bank of the United States, finances and insures U.S. exports, covering both commercial risk and political risk on foreign receivables. It has been doing this since 1934. The DFC, the U.S. International Development Finance Corporation, was launched in 2019 to support American investment in emerging markets through political risk insurance, debt, and equity, with an explicit mandate to offer an alternative to Chinese state-backed financing in the developing world. Both agencies exist for the same reason. Foreign governments actively subsidize their own exporters and investors, and these programs ensure American companies can compete on equal footing. EXIM Bank has several core programs. Short-term coverage insures receivables up to 180 days, widely used for consumables, commodities, and repeat manufactured goods, covering up to 95% of commercial and political loss. Medium-term covers capital equipment and services over 2 to 7 years, typically requiring 15% down from the buyer and covering up to 85% of the transaction value. Long-term programs support infrastructure, aircraft, and sovereign transactions out to 18 years, and the working capital guarantee works differently from the others. Rather than protecting against buyer default, it enables your bank to lend against your export orders and foreign receivables before shipment, solving the cash flow gap between winning a contract and getting paid. Who qualifies? More companies than most people expect. For EXIM Bank, the core requirement is at least 50% US-made content in your export. That covers a wide range of manufacturers, technology companies, service exporters, and agricultural producers. Small businesses are a priority. EXIM has a dedicated small business division with faster processing, and most short-term policies are under $5 million. For DFC, you need to be a U.S. entity investing in a qualifying developing country with a project showing development impact through job creation, energy access, or infrastructure. Both programs exclude sanctioned countries, but the vast majority of global markets are accessible. The numbers behind these programs reflect how seriously the U.S. government takes export competitiveness. EXIM Bank authorizes more than $7 billion in financing and insurance every year, directly supporting tens of thousands of U.S. jobs. The DFC has a total investment authority of $60 billion, making it one of the most capitalized development finance institutions in the world. Together, they are active in over 180 countries. To put that in perspective, Germany, China, Japan, France, South Korea, and Canada all maintain government-backed export credit agencies that actively subsidize their domestic companies in global markets. These programs are not exceptional. They are standard operating procedure. What is exceptional is when U.S. companies do not use them. An important point, EXIM Bank and the private insurance market are not competitors. They serve different needs, and on many transactions, both are in play at the same time. EXIM tends to be the right fit when your export has high U.S. content, when the buyer is a sovereign entity, a government utility, or a state-backed buyer, or when you need longer credit tenors beyond what private carriers will underwrite. The private market, through insurers like Lloyd's, AIG, Chubb, and Zurich, tends to offer faster turnaround, greater flexibility on deal structure, coverage for buyers in markets outside EXIM's reach, and whole turnover programs that protect a company's entire receivables portfolio rather than individual buyers. On large or complex cross-border transactions, the most effective coverage structures often layer EXIM or DFC alongside a private policy, using each program where it has the strongest fit. As an EXIM Platinum Broker, Impello's role is to help you find the right structure for your transaction, whether that is through government programs, the private market, or both. That starts well before any application. We look at your buyers, your markets, your credit tenors, and your deal structure to assess what programs actually fit. When EXIM is the right path, we help you navigate the application process alongside you. EXIM has its own forms, its own credit underwriting requirements, and its own approval timelines, and we work through all of that with you rather than handing it back for you to figure out alone. When a transaction spans EXIM, DFC, and private coverage simultaneously, we coordinate across all three, and throughout, we advise on policy terms and exclusions so you know exactly what you're buying before you sign. EXIM Bank and DFC are powerful tools when they are the right fit for your transaction. They are not the universal answer, and they work best when deployed alongside a clear understanding of what the private market can and cannot do. But for U.S. exporters and investors who qualify, they provide access to financing and risk coverage structures that are genuinely difficult to replicate on your own. If you're selling internationally, extending credit to foreign buyers, or deploying capital abroad, it is worth understanding whether these programs apply to your business. In the next video, we will cover supply chain finance and receivables financing, how exporters unlock working capital from their foreign receivables without waiting 60, 90, or 120 days to get paid. Subscribe so you do not miss it, and drop any questions about EXIM eligibility in the comments below.